Well, credit spreads are quietly widening, and I think it's more than a lot of people are aware of. I mean, I mentioned earlier that emerging market debt is down pretty sharply, and it's down 5, 6% year to date. We're 5 weeks into the year. We're down 5, 6%. And last year, emerging market debt was also negative of some significance on an index basis. So that's widening out. What's holding in are floating rate credit spreads because people are, wagering on this Fed trend to higher interest rates. But when you look at investment grade corporate bonds, they've widened now by, 20 basis points or so from their tights. I agree with you. It's not a lot. High yield bonds have been reasonably resilient, and stocks aren't down all that much. I agree. I remember back when there was a lot of turmoil that was starting to brew, whether that was I'm not sure if I'm talking about 2018 or early in 2020. We talked about how sloppy things were getting, and I said, "This is not sloppy. This is not panic. This is the prelude to panic." And unfortunately, I think that's where we are right now when it comes to credit spreads. Credit spreads are like the old from the Sun Also Rises. How did you go bankrupt? Two ways: first slowly, then very quickly. That's how credit markets deteriorate. First very slowly, and then all at once. Because one of the problems that the credit market is facing is that obviously Treasury rates have been rising, and bond returns were negative last year, and they're more negative this year. And so people don't like buying things that are delivering negative returns. And so one has to ask, when the Fed is not buying any bonds anymore, and when they start doing quantitative tightening, and there's not a lot of enthusiasm for fixed income broadly, what's going to stop prices from going down on some of this credit product, which, let's face it, thanks to the Fed's actions, didn't exactly enter 2022 as cheap. So I think we have more spread widening to go, and we all know that when spreads start to widen, you start to have problems in equity. So I think that you're right to say that, yes, there has been no panic. Markets held up pretty well, not exactly the NASDAQ, but certainly Dow Jones isn't bad. And so there's parts of the market that are doing well, but I do think that the obvious tailwind we've talked about for nearly 2 years, Judge, which is this quantitative easing and zero interest rates against the backdrop of escalating inflation, so massively negative interest rates, more negative than under Jimmy Carter. That's a problem when that starts getting taken away, because that's what's priced in. So you have to go to places where you're not being, on a sugar high, where you're not living on massive stimulus. So again, emerging markets are probably a place that I haven't bought emerging market equities yet, but I'm getting close. And I've started to recommend that it's okay to start averaging in, because the relative valuations of things are so out of whack. If you look at the United States, growth versus value, I mean, your value is as cheap as it was in Jimmy Carter day. And these are huge cycles that have massive swings. And value is as cheap now as it was in 1976 versus growth. And you see that you look at not just in the United States, growth versus value, but in developed markets. The PE of growth versus value in developed markets on average is about the same as it was 5-6 years ago. And yet growth is outperformed by 100%. And so we have very extreme valuations, which is never a catalyst. I completely agree with guests on CNBC that say, you can't just go on valuation. I completely agree. But it's so stretched at this point. And one thing that's really interesting is that relentless trend has started to show signs of reversing. You mentioned that I bought European stocks about a little less than a year ago. And as I said in my last appearance, it hasn't really worked versus owning U.S. stocks, but it hasn't not worked. It's almost exactly the same performance going back to the middle of 2020. And since we bought them, actually, European stocks have slightly outperformed. So that incredible trend of U.S. outperforming by 200-300%, some of these other regions, has already shown very significant signs of reversing momentum and starting to favor the non-U.S. investments.